Investing is one of the most powerful tools available to help you build wealth, secure your financial future, and achieve long-term financial goals. However, for many, the world of investing can feel overwhelming. There are countless investment options to choose from: stocks, bonds, real estate, cryptocurrencies, and more, and each comes with its own set of risks and potential rewards. The key to successful investing is understanding these options, how they fit together in a balanced strategy, and the importance of starting early. This guide aims to break down the basics of investing, highlight the different types of investment vehicles, and offer practical advice on how to grow your wealth with smart investments. One, the basics of investing, why it matters. At its core, investing is the process of using your money to purchase assets or financial instruments that have the potential to grow in value over time. Unlike saving, which typically involves setting money aside in low-interest accounts, investing takes on a bit more risk, with the aim of achieving higher returns. Whether you're investing for retirement, a down payment on a home, or other major life goals, smart investing can help your money work for you, rather than just sitting idle. Why should you invest? 1. Wealth creation. Through strategic investments, your money can grow faster than it would in a traditional savings account. 1. Over time, this can lead to a substantial increase in your financial resources. 2. Beating inflation. Inflation reduces the purchasing power of money over time. 2. Investing helps you grow your wealth faster than inflation erodes it. 3. Long-term goals. Whether it's retirement, buying a home, or sending your children to college, investing ensures that you have the resources needed to accomplish your life goals. Key principles to remember about investing. 1. Start early. The earlier you start investing, the more time your money has to grow. 1. This is one of the most powerful ways to take advantage of compound interest. 2. Be patient. Investing is a long-term strategy. 2. The market will have its ups and downs, but over time, investments tend to grow in value. 3. Risk and return. All investments come with some level of risk. 3. Generally, higher risk investments have the potential for higher returns, but the possibility of losses is also greater. 2. Types of investments. When it comes to building a portfolio, there are a variety of options to consider. Each investment type offers different risk, reward ratios, liquidity levels, and growth potential. Here's a look at some of the most common investment vehicles. A stock. Stocks, or equities, represent ownership in a company. When you buy stocks, you essentially buy a small piece of the company, and as the company grows, so does the value of your shares. Stocks can offer high potential returns, but they also come with the greatest risk due to their volatility. Stock prices can fluctuate significantly based on market conditions, company performance, and economic factors. Pros of stocks. 1. High growth potential. Historically, stocks have offered some of the highest returns compared to other asset classes. 2. Liquidity. Stocks are traded on public exchanges, so they are highly liquid, meaning you can buy and sell them easily. 3. Dividends. Some companies pay dividends to shareholders, offering an additional income stream. Cons of stocks. 1. Volatility. Stock prices can rise and fall sharply in response to market trends, economic news, or company performance. 2. Market risk. Stock prices can be affected by broader economic conditions, market sentiment, and global events. Tip: if you're a long-term investor, consider buying stocks with strong growth potential and holding onto them for years. Historically, stocks have outperformed other asset classes over extended periods. B. Bonds. Bonds are essentially loans made to governments, municipalities, or corporations. When you buy a bond, you're lending money in exchange for periodic interest payments and the return of your principal investment at the bond's maturity. Bonds tend to be less risky than stocks, but they also offer lower returns. Pros of bonds. 1. Stable income. Bonds pay interest periodically, providing a reliable income stream. 2. Lower risk. Bonds, especially government bonds, are generally considered safer than stocks. 3. Diversification. Adding bonds to your portfolio can help reduce overall portfolio risk. Cons of bonds. 1. Lower returns. While bonds are safer, they usually offer lower returns compared to stocks. 2. Interest rate risk. Bond prices tend to fall when interest rates rise. 3. Inflation risk. Bonds may not keep pace with inflation, especially those with fixed interest rates. Tip: bonds are a great option if you're seeking a stable, low-risk investment or want to balance the volatility of stocks in your portfolio. C. Real estate. Investing in real estate involves purchasing physical property to either generate rental income or benefit from property value appreciation over time. Real estate can be a great way to diversify your investment portfolio and add a tangible asset. Pros of real estate. 1. Tangible asset. Real estate is a physical asset that provides stability in times of market volatility. 2. Income potential. Rental properties provide regular income in the form of rent payments. 3. Appreciation. Over time, real estate values typically increase, especially in growing markets. 4. Tax benefits. Real estate investments often come with tax deductions related to mortgage interest, property taxes, and depreciation. Cons of real estate. 1. High upfront costs. Purchasing property requires significant capital, including a down payment and other fees. 2. Illiquidity. Real estate is not easily converted to cash. 2. Selling property can take time. 3. Maintenance costs. Properties require ongoing maintenance and can incur unexpected expenses. Tip: if you're just starting out in real estate, consider options like real estate investment trusts, REITs, which allow you to invest in real estate markets without directly owning property. D. Cryptocurrency. Cryptocurrency, such as Bitcoin and Ethereum, is a relatively new and highly volatile asset class. Cryptocurrencies are decentralized digital assets that rely on blockchain technology to secure transactions and manage the creation of new units. While they can offer high returns, they are also highly speculative and risky investments. Pros of cryptocurrencies. 1. High growth potential. Cryptocurrencies have experienced explosive growth in recent years, and some investors have seen substantial returns. 2. Liquidity. Cryptocurrencies can be bought and sold on exchanges 24/7. 3. Hedge against inflation. Some see cryptocurrencies, particularly Bitcoin, as a store of value and a potential hedge against inflation. Cons of cryptocurrencies. 1. Extreme volatility. Cryptocurrencies can experience dramatic price swings. 2. Regulatory risks. Cryptocurrencies face ongoing scrutiny from governments and regulatory bodies, which could impact their value. 3. Security risks. Digital wallets and exchanges can be vulnerable to hacking and theft. Tip: due to their volatility, cryptocurrencies are best suited for investors with a high risk tolerance who are prepared to hold them for the long term. E-mutual funds and exchange-traded funds, ETFs. Mutual funds and ETFs are pooled investment products where multiple investors combine their money to invest in a diversified portfolio of assets. Mutual funds are typically actively managed by fund managers, while ETFs are generally passively managed and track an index, such as the S&P 500. Pros of mutual funds and ETFs. 1. Diversification. Both mutual funds and ETFs offer instant diversification by investing in a range of assets. 2. Lower fees. ETFs generally have lower fees compared to mutual funds because they are passively managed. 3. Accessibility. These investment vehicles allow small investors to access a broad range of assets with a relatively low initial investment. Cons of mutual funds and ETFs. 1. Management fees. While generally lower than individual stock trading, mutual funds may still charge management fees that can eat into your returns. 2. Limited control. You don't have control over the individual assets in the fund, as the fund manager or automated system makes those decisions. Tip: mutual funds and ETFs are excellent options for beginners who want a hands-off approach to investing. ETFs are particularly attractive for those looking for low fees and broad market exposure. 3. The importance of starting early. The sooner you start investing, the better your chances of accumulating wealth. The key to long-term investment success is compound interest, the ability for your investments to earn returns on both the initial principal and the accumulated interest. Why starting early is crucial. 1. Compound interest. The earlier you begin investing, the more time your money has to grow exponentially. 1. For example, investing $1,000 at age 25 with an average annual return of 8% will grow to $10,000 by age 65. 2. Long-term growth. By starting early, you can withstand market volatility and still benefit from long-term growth. 2. The longer your money is invested, the more you can ride out short-term market fluctuations. 3. Reduced risk. Starting early allows you to take more risks in the beginning, with higher potential returns, and as you near your financial goals, you can gradually shift to lower risk investments. 4. Managing risk and building a diversified portfolio. One of the most important aspects of investing is managing risk. All investments carry some level of risk, but by diversifying your portfolio, you can minimize the impact of any one investment's poor performance. Diversification involves spreading your investments across different asset classes, such as stocks, bonds, real estate, and more, so that if one sector suffers, the other investments can offset those losses. Key risk management strategies. 1. Diversification. Invest in a variety of asset classes, stocks, bonds, real estate, etc., to spread out the risk. 1. Asset allocation. Determine the right mix of investments based on your financial goals, risk tolerance, and investment horizon. 2. Regular rebalancing. Over time, certain investments in your portfolio will outperform others. 2. Regularly rebalance your portfolio to ensure it stays aligned with your goals. Tip: if you're just starting out, a simple way to build a diversified portfolio is to invest in target date funds or low-cost index funds. These funds automatically adjust their asset allocation based on your age and retirement date. Investing for the future is not about making a quick profit or trying to time the market. Instead, it's about building a strategy that works for your personal goals and sticking with it over the long term. While there are risks involved, the potential rewards of investing, whether it's through stocks, bonds, real estate, or other asset classes, can significantly enhance your financial well-being and future security. The key takeaways. 1. Start early to take advantage of compounding. 2. Diversify your portfolio to spread risk. 3. Be patient and stay committed to your long-term financial goals. 4. Regularly reassess your investments to ensure they align with your changing needs and circumstances. With the right mindset, informed decisions, and a disciplined approach, you can grow your wealth over time and enjoy a secure financial future. The most important thing is to start today. The sooner you begin, the sooner you'll see the fruits of your investments. Happy investing!